Imagine this. You're at a bustling farmer's market, and everyone is flocking to one stall. Without even realizing why you do it, you find yourself being drawn into the crowd. Social herding. It's a powerful force, and it's far more than just a phenomenon at a marketplace. In financial markets, this instinct can feel like a warm safety blanket, but it also has the potential to lead us straight into the fire. Social herding is the tendency for individuals to mimic the actions of a larger group, often without their own independent thought or analysis. In the world of investing, this behavior is rampant. People see a stock price soaring and suddenly feel an overwhelming urge to jump on the bandwagon. It's almost as if the rush of adrenaline from seeing others make money clouds our judgment. The truth is, our brains are wired to follow the herd, a survival mechanism from the early days of humanity. Back then, sticking with the group could mean the difference between life and death. Fast forward to today, and while the stakes might not be quite as extreme, this ingrained behavior still influences our decisions, especially when it comes to money. The financial world is rich with tales of social herding leading investors astray. At the core, it's about fear and greed, the twin emotions that often govern market behavior. When a stock is rising, greed kicks in, urging us not to miss out. On the flip side, when panic sets in and people start selling, fear can drive us to do the same. It's a cycle that perpetuates itself and can create a self-fulfilling prophecy. But what we must ask ourselves is this: just because a large group of people are doing something, does that make it the right course of action? Let's bring this idea into sharper focus with some real-world examples. Consider the dot-com bubble of the late 1990s. During this period, the internet was booming, and everyone wanted a piece of the action. Investors flocked to tech stocks, often with little understanding of the companies they were investing in. The belief was that the internet was the future, and any company associated with it was bound to soar. But it was precisely this herd mentality that inflated the bubble to unsustainable levels. When reality hit and companies failed to deliver on their promises, the bubble burst, leaving countless investors with massive losses. Then, there's the more recent phenomenon of meme stocks. Remember the GameStop frenzy? It was a clear display of social herding in the modern age, amplified by social media. Investors, many of them retail, jumped into buying because everyone else was doing it. The stock price rocketed, driven not by fundamentals, but by a collective belief in potential gains. While it made some early adopters very wealthy, not everyone was so lucky. Those who bought in late, swept up in the excitement, often found themselves facing steep losses when the hype dissipated. So how can we, as investors, break free from the cycle of social herding and make wiser, more informed decisions? It starts with awareness. Recognize that our instincts to follow the crowd are not inherently right. Pausing to question why a particular stock or asset is gaining popularity can be a powerful tool. Is there genuine value and growth potential? Or is it simply a case of the emperor's new clothes? Successful investors often use data-driven strategies to rise above the noise. They focus on fundamentals, such as a company's earnings, market position, and competitive advantages. Warren Buffett, for example, famously advises to be fearful when others are greedy and greedy when others are fearful. This contrarian approach requires a level of discipline and independence that doesn't come naturally to most. It involves rigorous analysis and a willingness to stand apart from the crowd, sometimes even in the face of ridicule. These investors also understand the importance of diversification. By spreading investments across various asset classes and sectors, they mitigate the risk of any single investment's failure. Furthermore, they maintain a long-term perspective, resisting the urge to make impulsive decisions based on short-term market movements. But knowing what strategies work is only part of the solution. The real challenge is recognizing when social herding is influencing your own decisions. Are you buying that stock because you believe in the company's potential? Or are you simply reacting to what everyone else is doing? One method is to set clear investment goals and criteria before making a purchase. This pre-commitment can serve as a guiding light, helping you stay on course even when the market is chaotic. In the next sections, we'll dive deeper into how you can spot the signs of social herding and strategies you can employ to resist its pull. Remember, the goal is to empower yourself to make choices based on sound analysis, not the whims of the crowd. In the fast-paced world of investing, data-driven strategies are your best armor against the pitfalls of social herding. Successful investors rely on rigorous analysis to guide their decisions, rather than the noise of popular opinion. They dig deep into financial statements, scrutinizing a company's earnings, revenue growth, and debt levels. This meticulous attention to detail allows them to assess the true value of a company, distinguishing between genuine opportunities and market hype. Take, for instance, the strategy of value investing. This approach focuses on identifying stocks that appear undervalued by the market. By analyzing a company's intrinsic worth based on its fundamentals, value investors can spot potential bargains that others might overlook. This methodology requires patience and diligence, as it often involves waiting for the market to recognize the company's true value. Contrastingly, growth investors seek out companies with strong potential for future expansion, even if their current valuation seems high. This forward-looking perspective requires a keen eye for industry trends and innovations. Beyond individual stock analysis, broader economic indicators also play a critical role in informed investing. Savvy investors pay attention to macroeconomic factors such as interest rates, inflation, and geopolitical events, which can all influence market conditions. They understand that these external factors can affect entire sectors, shaping the landscape in which their investments operate. Moreover, diversification cannot be overstated as a core strategy for mitigating risk and countering herd mentality. By spreading investments across different asset classes and sectors, investors reduce their exposure to any single market downturn. This balanced approach not only stabilizes potential returns, but also provides flexibility when adapting to changing market conditions. It's a wise way to buffer against the volatile swings that often accompany herd-led investments. Now, with a firm grasp on data-driven strategies, the next step is learning to identify and avoid the subtle cues of social herding. One telltale sign is the pervasive chatter around a particular investment. If you're hearing about a stock or asset repeatedly across various media platforms, social herding might be at play. It's easy to get swept up in the excitement, but it's crucial to step back and conduct your own research. The goal is to assess whether the buzz is warranted by strong fundamentals, or if it's merely a speculative bubble. Another red flag is the fear of missing out, or FOMO, which can cloud your judgment and lead to impulsive decisions. When you feel the pressure to act quickly because everyone else seems to be benefiting, pause and ask yourself if this aligns with your long-term goals. Investing is not a race. It's a journey that requires thoughtful consideration. Peer pressure, even if subtle, can also sway your decisions. Whether it's friends, family, or colleagues, the opinions of those around you can heavily influence your investment choices. While discussing ideas can be beneficial, ultimately, your portfolio should reflect your own research and risk tolerance, not someone else's whims or pressures. To truly empower yourself in the investment world, fostering independence and informed decision-making is key. Start by establishing clear investment goals based on your financial situation and risk appetite. Whether your aim is to build wealth over the long term, generate short-term gains, or preserve capital, having a clear objective will guide your investment strategy. Create a structured plan with predetermined criteria for buying and selling assets. This pre-commitment can serve as a safeguard against emotional, knee-jerk reactions to market fluctuations. Stick to your criteria, even when the herd is stampeding in another direction. This discipline will help you stay grounded and focused on your personal financial goals. Additionally, continuous education is invaluable. The more you learn about financial markets, economic indicators, and investment strategies, the better equipped you'll be to make informed decisions. Stay updated with financial news, read investment books, and consider seeking advice from financial experts if needed. Knowledge is power, and in the world of investing, it provides the confidence to act independently. Finally, remember that patience is a virtue. Markets will always have ups and downs, but your long-term commitment to a well-thought-out strategy will serve you well. Embrace the idea that it's okay to stand apart from the crowd, even when it feels uncomfortable. True financial success often comes from making decisions grounded in careful analysis and steadfast principles, rather than following the herd. As you chart your path in the investing world, let each decision reflect your own analysis and convictions. Trust in the process, and you'll find that acting independently often leads to more consistent and satisfying outcomes. If you found this video helpful, don't forget to subscribe to our channel for more insights on wealth building, personal finance, and financial psychology. Join our community of informed investors and empower yourself to navigate the financial markets with confidence and clarity.